Hello, finance friends. In a previous lecture, we did a really broad top-level overview of investing. And that was the lecture, Principles of Investing. Went through a few general concepts and just took a look at investing from a very top-level perspective. Now, in that video, we also touched on the idea of asset classes, and we identified the primary asset classes. And in this video right now, lecture 7 in our series, we're going to dig a little bit deeper into stocks, bonds, and mutual funds. So that's the topic of this video. So let's start off with stocks. And we'll start from the top and then slowly drill down from the very broad kind of conceptual into a lot more granular with some math and some basic measurements. So let's start off with number 1, stock basics. Now, as we mentioned in the previous video, what a stock is, and again, stocks are also known as equities, so those two terms are used interchangeably. What a stock is, at its core, is a share of ownership in a company. So a stock, it's a financial security. Obviously, you buy it for the purpose of growing your wealth. A stock is an asset, a financial security, and as a stockholder, as a shareholder, you have partial ownership in a publicly traded company. And that's the key. So when you participate in the financial markets by buying stock, you are participating through the lens of an owner, because all stockholders are partial owners of the companies in which they hold stock. Now, that's very important, because if you're a shareholder or a stockholder, you don't just own a piece of paper. No, it's much more than that. As a shareholder or stockholder, you have a proportionate share of the income, the assets, and the future cash flow of a company. So let's say that hypothetically there was a company that had 100 shares of stock outstanding, and you own 2 of those shares. This implies that you own 2% of the company's stock, and that you are therefore also a 2% owner of that company. Well, what that means is that you have the legal right to 2% of the company's income, its assets, and its future cash flow. And it's in particular this idea of the future cash flow of a company that gives a stock its value. Because as an owner, you have a share of future growth, and that growth has potential value. So that's what a stock is. Now, among the major asset classes, over time, stocks, equities, stocks have provided investors with the highest rate of return. Therefore, this means that if you want to have a portfolio that grows, and if you want to generate long-term wealth in your portfolio, you probably need to have stocks, or ideally for you, stock mutual funds, but for now, we'll just say stocks. You ideally have stocks in your portfolio. You can think of stocks as being the real driver, the main engine of growth in your portfolio. But as we learned in a previous lecture, to get return, you have to accept risk. So while stocks have the highest historical rate of return of the major asset classes, they also are characterized by having higher levels of risk and volatility. And you have to learn to accept that if you're going to invest in stocks. When it comes to this idea of risk and volatility, we use a very specific term when we're looking at the stock market and stock, or what we call equity investments. And that term is beta. Beta is a measurement of a stock's volatility. And it works like this. So beta measures the volatility of a particular stock, and it measures that volatility of that one stock relative to the market as a whole. So that's the key. When you look at the beta for any security, you're looking at that security's volatility relative to the market as a whole. Since the market as a whole is what you're comparing to, the beta for a particular market or the beta for a particular market index is always going to be 1. So we would say that for a market or a particular market index, beta is going to be 1.0. Now, what does this mean? Well, let's suppose, so we know that just as a matter of technical necessity, the beta for the market or for the market index is going to be equal to 1. Suppose that you're considering a stock. You want to buy an individual stock, let's say, and in your research, you find that that stock has a beta of, let's just say, 1.2. Well, what that means is that that particular stock is 1.2 times riskier than the market as a whole. What this means in turn is, let's say that hypothetically, the market goes up by 10%. Well, if the market goes up by 10% and this particular stock is 1.2 times more volatile than the market, then if the market goes up by 10%, then we would expect this particular stock to go up by 1.2 times 10% or 12%. So that's how beta works. Generally speaking, any beta greater than 1, so how about this? Any security or equity or stock with a beta greater than 1 will have relatively more volatility than the market as a whole. Any security or stock that has a beta of less than 1 will be less volatile than the market as a whole. And by simply, again, like we did it right here, by simply multiplying the overall market movement or the expected market movement by the beta of that one stock, you can predict how that stock will behave. Okay, so that's beta. Once again, it's a measure of the risk or the volatility of a particular security, of a particular stock relative to the market as a whole. So now stocks can be sliced and diced and cut up in lots of ways. So there's lots of different types of stocks and there's lots of terminology. I just want to expose you to some of the basic jargon. Stocks can be categorized in lots of ways, including as blue chip stocks, you hear that term a lot, or growth stocks or value stocks, income stocks, cyclical stocks, defensive, large cap, mid cap, small cap. All of these terms are used. Generally speaking, growth stocks are expected to grow in value over time. Value stocks are perceived as being underpriced relative to their true value. So you buy a growth stock, and again, there's a lot of also crossover in these terms, but generally speaking, when you buy a growth stock, you're buying a stock that you think is fairly priced, but you expect it to grow over time, right? To generate long-term future cash flow, which increases the value of the stock to the owners. If you buy a value stock, you're sort of making the bet that the stock as it's currently priced is undervalued or underpriced compared to its long-run potential. So you're trying to buy it like at a bargain. When you hear these terms right here, large cap, mid cap, and small cap, this refers to what's called the market capitalization of a stock. The market capitalization of a stock is equal to the price per share for that stock multiplied by the number of shares of that stock that exist. So by taking the number of shares of stock that exist and multiplying it by that price per share, you get the overall market capitalization of that company. And simply, large, mid, and small cap refer to categories of companies where the market capitalization is relatively small or somewhat in the middle or really, really high. Okay, so you can analyze stocks as being large cap value or large cap growth or even large cap blended. Income stocks are sort of designed to generate income, often in the form of dividends. So there's lots of different ways that you can slice and dice this. It's just a matter of hearing some jargon and being comfortable dealing with jargon. Stocks can also be classified as common or preferred. For most of us, when we buy stocks, we're looking at common stocks. A common stock is characterized by a few things. Number one, it's the most common form of ownership. And traditionally, when you have a common stock, you as the shareholder have, legal rights to the future cash flow and to the assets of that company. But common stock also entitles you as a shareholder to the right to vote on top level issues, including board of director seats. Preferred stock is a little bit different. With preferred stock, you oftentimes give up voting rights. Now you might ask, well, why would I give up voting rights? Well, here's the answer. I'm getting a bit ahead of ourselves, but it's okay. We know that stocks can provide value in two ways, one through growth over time and one through current income, which in this case of a stock is a dividend. Now, to make a long story very short, dividends have to be paid out of a company's free cash flow, and dividends have to be authorized every period by the board of directors. Okay. With a common stock, in theory, you're going to get your dividend paid. But with a common stock, the dividend is not necessarily guaranteed. With a common stock, if a company has a really bad year, if their cash flow suffers, the board of directors for that company could vote to suspend or even halt the dividend that it pays out to shareholders. Now, this is not something that companies want to do lightly because that sends a lot of bad signals and that can really affect the value of the stock. But at least in theory, if you own a share of common stock, you'll expect your dividend, but it's not guaranteed. On the other hand, preferred stockholders, the dividend is effectively guaranteed, and preferred stockholders have legal claim to dividends ahead of common stockholders. So with the preferred stock, in essence, you're sacrificing the voting privileges, and in exchange, you're taking on a few different benefits, but primarily the benefit being that you're going to have first access legally protected dividends, okay? Another term you might often hear when it comes to stock is the idea of a stock repurchase. Now, again, if you think about a company, every company operates by selling items, and the companies bring in revenue and they take on cost. And the difference between the revenues that a company brings in and the cost that it sends out, that's basically the company's profit. You can also think of that as the company's free cash flow. In other words, the cash that is left over from a company's operations after it pays for all of its expenses. That's its free cash flow. Now, if you put yourself in the lens of a company, companies have several options on what they can do with their free cash flow. So number one, the company can use its free cash flow, pay a piece of it out to shareholders as a reward as a dividend. Companies can also take their free cash flow and plow it back into the company. So you can imagine a company that's maybe a younger company. They're really trying for aggressive growth. They want to get bigger and grow. That company might say, we're not going to pay dividends. Instead, we're going to take every dime of our free cash flow and plow it back into the company's operations. Invest in new products, in new marketing, in growth. And a third thing that a company can do with its free cash flow is it can take part of that cash flow and go into the market and repurchase shares of its own stock. That's called a repurchase. And basically, a company would do that, at least in theory, if a company felt that the best use of the money was to buy back its own shares. In other words, if a company realized, well, we've already paid our dividend, we don't have any other big projects we can put the money into, they may use that leftover cash to repurchase shares. Now, there's a lot of other things, there's a lot of other reasons why companies might do repurchases. And in this sense, we can very easily slide from the financial, economic into the political, because share repurchases are, many people are indifferent to them, but some people really, really like them, and a lot of people are vocally opposed to them. But that's beyond the scope of this lecture. Just know that's what a share repurchase is. One thing to think about, if the company is repurchasing its shares, you have to be thinking about that repurchase as an opportunity cost of the free cash flow. If you're a shareholder in the company, think about what that might imply for you. So anyway, those are some stock basics. I have here, you can pause the video and look at this if you'd like. I'll leave it up for a few seconds, but basically a chart that gives you in this column, term, in this column, the definition, and then in this column, maybe what that type of stock might mean to you and what role it might play in a portfolio. So there's some of the basics of jargon. So take a look at that. All right. Now, in our previous video, we had learned that stocks will generally provide return in one of two ways. Okay, so stocks, like any other asset, will generally provide return to investors in two ways. The first way would be the growth in the value of the stock. In other words, you buy a share of stock for 100 and later on it's worth 300. Okay, that ties into capital gains, but it's ultimately an appreciation in the share price of a stock, an appreciation in the stock's value. The second way that a stock will provide return is in the form of a dividend. And again, dividends are current income. Remember from that previous lecture, all investments can provide return in one of two broad ways, either an increase in the value of the asset or in the current income that the asset generates to the owner. In the case of a stock, this is the dividend. So that's what a dividend is. It's a form of current income, and it's one of the two main ways that a stock can generate return for you. With this in mind, a really important idea is a concept known as the dividend yield. And the dividend yield is this. It is the annual dividend that is paid per share divided by the current market price per share. So if you think about it, what the dividend yield is, it's always going to be expressed as a percentage. What the dividend yield is ultimately how much dividend are you getting back based on what you paid in. Okay, yields are always some form of what am I getting back as a function of what I paid in. So in the form of in the dividend yield, in the form of a dividend yield, it is how much cash is this stock generating for me in dividend as a function of how much the share costs. Now, it's important to also know this is not the price that you paid for the share sometime in the past. It is the price right now. In other words, right here, right now, how much do I have to pay in order to generate a certain amount of dividend income? Okay, that's expressed as a percentage, and by expressing it as a percentage, it allows investors to make comparisons of different potential assets, because we're always going to want to compare the return that we get for the for the risk that we take on. So that's dividend yield. Okay. Now, quick pause here. I said in the previous video that I don't think that any beginning investors have any business buying individual stocks. Okay, you're probably better off with the diversification and the ease and the simplicity of mutual funds. But again, I'm not here to give you advice. You do your own research. But let's just say that we stick with theoreticals here. If you were considering buying a stock, or any asset for that matter, on an individual basis, when would you buy it? And finance theory suggests that, again, in theory, you would buy any asset, including a stock, if, okay, always, always, always the ifs, you would buy any asset if the expected rate of return of that asset exceeds your required rate of return. So again, let's put this in some simple terms. You would buy if the expected return is greater than your required return. If you've studied principles of economics, this goes back and ties directly into one of the fundamental concepts in econ theory. We would say in economic principles, you would always take an action if the marginal benefit exceeded the marginal cost. So you can sort of consider the expected return on an asset to be the benefit of owning that asset, and the required return on that asset, that's the opportunity cost. In other words, the required return on any asset is what you can get elsewhere. So it's effectively a marginal cost. And just like you would perform an action in economic theory if the marginal benefit exceeded the marginal cost, in a similar way, under finance theory, you would buy an asset if its expected rate of return exceeds its required rate. Now, we have to then define these. So let's start off by defining the required rate of return. A stock's required rate of return. This is basically how much return you need to get on that asset to make it worthwhile. Well, if you think about it, since the required rate of return on one asset, well, I should put it that way. Think of it this way. The required rate of return on an asset is its opportunity cost. In other words, what you're asking is, what could I get on a similar risk asset elsewhere? So ultimately, the required rate of return is tied to the opportunity cost of an asset. Okay. The formula that we use goes back to a couple of ideas we've already kind of introduced. The required rate of return. So R is your rate of return. Your required rate of return is equal to your risk-free rate of return plus your risk premium. Remember, the risk-free rate of return is the return that you can get on an asset with no real risk taken on. That's generally going to be, the proxy for that today is the 10-year yield on a US Treasury bond. And then the risk premium is the additional return or the additional reward that you need given the additional risk that you're taking on. We had learned in a previous lecture that there is a direct relationship between risk and return. So if you're taking on more risk, you need more return to reward you to offset that risk. Okay, that's the risk premium. So if you take the risk-free rate of return that you can get on a no-risk asset, and then add to that the premium that you need on the current asset that you're looking at, adding those together will tell you the return that you need on this asset. Now, we can use some other basic math to solve this. The risk-free rate of return, we said, is the 10-year Treasury rate. The risk premium is going to be equal to the stock's beta times the overall market risk. Remember, beta is a measure of risk for one individual asset relative to the whole market. So if you can get the overall market risk as a percentage, multiply it by the stock's beta, you'll get the risk factor for that security. You add that, which is the risk premium, to the risk-free rate, and there you go. So this is something that you're probably not going to use in the real world, but in finance classes and MBA classes, they love it because we can give you lots of data and then you can go in and plug in numbers and get your solutions and make some sense of it. So that's your required rate of return. Now, what's your expected rate of return? Well, your expected rate of return is sort of the marginal benefit for owning a security. Now, this right here, this is the formula for the expected rate of return. So a stock's expected rate of return is equal to this divided by this. Let's break it down. Remember, every asset can generate return by either the growth in the value of the asset or by the current income. So the expected rate of return is equal to the average annual current income plus the projected price, which would be the future price, minus the current price, divided by the number of years. So this here gives you the current income, and this gives you the expected growth. Those are your two forms of return. You add those together, and you divide it by the projected price plus the current price divided by 2. Doing that will give you a rough approximation of the stock's expected rate of return. Now, in a finance problem, in an in-class lecture problem, in an MBA problem, this is fantastic. In the real world, though, I mean, you can look at this and just note all the difficulties here. How can you predict what the future price of a stock will be? It's very hard. The future price of a stock is tied to its future cash flow and then the discount rate. So you have to estimate the discount rate, estimate the growth prospects. How can you be sure that you're going to get a dividend? And if you get a dividend and you get it in the future, will it stay stable? Will it grow? If it grows, at what rate will it grow? So again, there's a lot of assumptions built into this and a lot of difficulties. But from a pure technical stance, this is the formula to give a rough approximation of the expected rate of return. If you take this and compare it to this, you would make at least a conceptual decision. Should I buy this stock or not? Does it satisfy the hurdle rate that I needed to satisfy to make it a worthwhile investment? Okay, so that's that. Now, in addition to that, investors and professional analysts apply lots of other ratios and metrics to analyzing stocks. I just wanted to share with you, when it comes to stock evaluation, some of the more common metrics that are used. And these are among the biggies. Earnings per share, what's called the price to earnings ratio, the dividend yield, the book value of a stock, current ratio, and debt ratio. All of these tools and many others are used by professional analysts and by professional investors to make comparisons and to kind of draw conclusions and to determine if a stock is a good investment or not. Okay. Personally, I don't think you need to bother with any of this. You can just buy mutual funds and you'll be okay. But again, even if you buy a mutual fund, let's say that you buy a stock mutual fund, that's going to be a mutual fund that owns stocks. Even though you don't own stocks directly, you're still going to be exposed to the volatility of those stocks. So it's at least good that as an investor, you have a basic idea of some of the basic metrics and key jargon that we use. And here's 6 terms, 6 metrics that professionals use to invest in stocks. This table right here, I give you the ratio and I tell you what it measures. And in a later lecture or in our in-class time, we'll do a few calculations to practice this, but there you go. Okay. I had said a while ago that how do you project the future price of an asset? It's very hard. But I did want to share with you what pure finance theory has to say about that. In pure finance theory, so in corporate finance and financial analysis, any asset's current value is equal to the present value of all of its future cash flows. Some of these terms should sound familiar from our time value. So any asset's current value, meaning for any asset, the current market price of the asset is said to be equal to the present value of all the expected future cash flows. Of course, if it's the present value, that implies that you're taking those future values, those future cash flows, and you're discounting them. So we have to have a discount rate as well. And if you think about it, present value, future value of flows, number of periods, discount rate, we have all the key ingredients that we would plug into a financial calculator, okay? I tell you this, though, because I want you to know what stock analysts are often looking at. And since we're talking about the present value of future cash flows, stock analysts, therefore, they pay attention to a lot of variables, but among the big variables that they look at are these: the company's current level of earnings, the company's expected growth rate for its earnings, which is a proxy for the future cash flows, and then the company's risk, which would be used to determine the discount rate by which we pull those future cash flows back to the present, thus determining the present value and the price. Now, if this sounds complicated, trust your instincts. It's extraordinarily complicated. It's tricky. It's time-consuming. It's part art and part science, so it's highly, highly error-prone. And let's be very honest here. You, as a non-professional, you will not be good at it. Sorry, but you won't be. Oops. But that's okay. That's where mutual funds, the right tool for the job, comes in. You don't have to be good at picking individual stocks. You don't have to go through all the energy and time consumption of all these calculations. You can just buy a mutual fund that owns a bunch of different stocks and get all the benefits of ownership with none of the costs of the research that individual stock buyers have to go through. Okay? Now, with that said, I will offer you one last thought. Suppose that you say, Eric, I think you're wrong. I think that I have what it takes to pick the winners and to pick individual stocks and to do that consistently. Hey, if you believe that, I'm not going to try to stop you. But at least have the intellectual courage to compare. And by that, I mean, if you do attempt to pick individual stocks, at least have the intellectual courage to periodically calculate the return, the percentage return on the stocks that you bought, and compare that return to the returns of a stock index. If you say, I've run my numbers and I averaged a 6% return, but then you realized, like, let's say that you bought individual stocks, you ran your number, you said, oh, I did all this research, all this legwork, I picked these stocks and I earned a 6% return. And then you realize that the S&P 500 index had a return of 8%, you made a bad move. You could have just bought a VFIAX 500 index fund, mimicked the index and earned the 8% that the index generated, as opposed to the 6% that you generated with all the risk and volatility and time and energy involved. So my view, it's not advice, but my view for me, I don't try to beat the market. I don't buy individual stocks. I just buy mutual funds. I get exposure to everything with none of the hassle. But if I were going to try my hand at individual stock picking, I would have to discipline myself to have the intellectual courage to calculate my returns appropriately and then compare my returns to the alternative of the index. And that's always a good practice to get into. Remember, making a lot of money and growing wealthy, it's not just about doing the right things, it's about avoiding the dumb errors. So whenever you're tempted to make dumb errors, or whenever you tend to take risks like that, always build in ways that you can measure and check and balance yourself, okay? So there we go. With that said, let's wrap up this part of the discussion by looking at stock investing strategies. Now, obviously, since stocks are the engines of growth in your portfolio, you probably need stocks in your portfolio if you want it to grow. Okay, so you're going to want to have some stocks in your portfolio. The question then is, what strategies should you follow? Should you buy individual stocks or look at a different strategy? And I would offer to you that you should consider looking at a different strategy. And that is, once again, using your spare cash to buy no load, low fee, low expense ratio, passively managed, boring, plain vanilla stock index funds. Some of those are going to be funds that would mirror the S&P 500, like Vanguard's fund VFIAX. Just to be clear, I am not advocating that you buy Vanguard funds. I'm just telling you what I invest in. So a lot of my holdings are in VFIAX, which means that most of my money is invested in an index fund that simply attempts to mimic the performance of the stocks of the 500 largest traded firms in America. There's also one that's called VTSAX. This is the Vanguard Total Stock Index. This tracks the performance of both the really big 500 stocks, but all the other stocks, including really small stocks too. So VTSAX takes you from the large cap to the mid cap and even the small cap stocks. But either way, I think strategy number one, no load, low expense, passively managed index funds. Number two, do not try to time the market and buy and sell and buy and sell. Find good stuff to buy it, and hold it forever by investing with the buy and hold approach. And then finally, to maximize compounding and to minimize dumb human monkey primate errors, we want to automate our system. So automate your investments and also automate DCA, dollar cost averaging, as well as DRIP, dividend reinvestment. That allows you don't have to bother trying to time the market. You can take advantage and buy more shares when the market's low. With DRIP, you'll reinvest your dividends and maximize your compounding. And by automating it, you'll do a little bit every paycheck or every period. You know from your time value concepts that basically makes your investing life an annuity. And you know from the factor tables just how much power an annuity over time has. So those to me are good strategies. Bad strategies, basically the opposite. Bad strategies, trying to time the market. You can't. Buying individual stocks. Well, it's very risky because now you're holding your eggs in fewer baskets, but also what was your basis for buying that stock? How'd you research it? And remember, if you just own one stock or even just a handful of stocks, you're going to suffer from a lack of diversification. Day trading and trading advanced esoteric things like options and derivatives, as well as using leverage, meaning that you're borrowing money to buy stocks, that's probably a bad idea. And again, going back to the point in an earlier lecture on controlling what you can control your expenses. So paying sales loads or excessive expenses and fees, another bad idea. Because every dollar in fees that you pay to a brokerage house is a dollar in growth that future you will not get. And that, my friends, are some thoughts on stocks. Now let's turn to the second of the major asset classes, bonds. So let's start asking, what is a bond? A bond is, in effect, an IOU. Whenever an entity, maybe a government, maybe a company, maybe a nonprofit, maybe a university, whenever an entity needs to raise money, they can raise that money by borrowing it. And entities, including companies, they borrow money by issuing bonds. So think about this. We said a moment ago that if you buy a stock, you're participating in the economy as an owner. When you buy a bond, you participate in the economy as a lender. In this case, you're loaning some of your surplus capital, some of your excess cash, which of course you know you need to run net cash flow positive to generate, but you're going to take some of that cash and you're going to use it to lend it to a company. Now, just like stocks also go by a different name, equities, bonds also have a more fancy name. So we can call them bonds, but they're also known as fixed income securities. And that name comes from the fact that with a bond, when you buy a bond and effectively loan money to an entity, that entity promises two things to you. So you go out and you buy a bond, you buy a Tesla bond or a Microsoft bond or an LMU bond, or it doesn't matter what the bond is, you buy a bond. The person who is borrowing your money and selling you the bond, they're promising you two things. Number one, they're promising to pay you interest every year over the bond's life. This would be, remember, what we would call current income. The income that is generated by you owning the asset. So when you loan money to a company, that company, number one, is promising to pay you interest for as long as you own the bond. And then number two, at the bond's maturity, they're promising to pay you back the amount that you borrowed, which is called the principal. Bonds are known as fixed income securities because of this one. Because when you buy a bond, you're banking on having a fixed amount of money, interest, come in every period. This may not mean a lot to you when you're younger, but you can imagine maybe older investors, people getting ready for retirement, where they don't need the growth so much as they need stable, predictable sources of income that can make bonds very attractive for them. Okay, so that's what a bond is. Now, it's important to note that bonds have what's called a maturity, and that's simply the length of time for which a bond is active and for which you'll receive interest. So let's say that hypothetically you buy a bond with a 10-year maturity. That means that the bond will be paid back to you in 10 years. That means that you'll have 10 years of interest payments, and then 10 years from now, you'll get paid back. Okay, so that's maturity. But here's something that's very important and what a lot of newcomers to investing kind of stumble over. Let's say that you buy a 10-year bond today. You have really two options. Option number one, you can hold that bond until maturity. So today you buy a 10-year bond. You can just hold that bond in your portfolio for 10 years, getting your interest payments every year, and in 10 years, expecting the company to pay you back. So you can hold it until maturity, at which time you're going to get your final interest payment and get paid back. But you do have, as a bond holder, another option. As a bond holder, you own the asset. And like any asset, you have the right to sell that asset. So you can hold your bond to maturity, but you can also go into the bond markets and sell your bond before maturity. So if you buy a bond today, starting tomorrow or anytime that you want in the future, you can take that bond, go into the bond market, and sell that bond to another investor who wants to buy it. Note that if you sell a bond before maturity in the bond markets, that's going to generate a capital gain or a capital loss, depending on if the price that you sold it at is greater or less than the price that you paid for it. Okay, so it's kind of confusing. There's a lot going on here, but just be aware of how bonds perform and the fact that as an investor, you have the option of holding your bond to maturity or selling it ahead of time to generate cash. Okay, so some bond basics. Who issues bonds? Bonds can be issued by the U.S. Treasury, by private corporations, by states and local county agencies, by international entities, etc. One quick thing, U.S. Treasury bonds are bought by the U.S. government as a way to finance the government's operations. Note that within the U.S. Treasuries, bonds can be called either bills, notes, or bonds. That's a technical term. They're all the same thing. They're all IOUs. Bills have a maturity of less than 1 year. Notes have a maturity from 1 to 10 years. And technically, bonds have a maturity of more than 10 years, including one of the most popular issues, the 30-year bond. Ultimately, the mechanics don't matter. It's the same mechanics, but just know when you hear the term U.S. Treasury bill, U.S. Treasury note, or U.S. Treasury bond, the jargon ties into the maturity for the instrument, okay? In addition to who offers and sells bonds, you should know that some bonds have conditions applied. One condition is called a callable bond. With a callable bond, the issuer, the person who borrowed your money and sold you the bond, they can actually force you to redeem it before the maturity date. When would this happen? Well, let's just say that today interest rates are 7%. We'll make this number up. I buy a bond from you. I sell you a bond. I'm a company. I sell you a bond. I have to pay you 7% interest. And let's say that in the next couple of years, interest rates fall to 2%. Well, I certainly don't want to pay you 7 when I can borrow new money at 2. So if I have a callable bond, I can actually force you to redeem your 7% bond early, allowing me to save on interest payments. There's a convertible bond. A convertible bond is a very unique hybrid structure where if I'm a company, I have both stocks and bonds. I sell you a bond. With a convertible bond, you as the bond holder have the option to convert that bond into my stock. And then the third condition, this tends to be for riskier bonds, it's called subordination. With the subordination condition, this means that the bond will only be paid out, the interest paid and the bond redeemed, after all of the other loan obligations are paid off. In other words, if you buy a subordinated bond and the company that you bought the bond from goes through any kind of financial distress and they're having some issues, you are the low man on the totem pole and everybody gets paid out before you have legal rights to get paid out. So just be aware of this. Obviously, a subordinated bond would be riskier, and hopefully you would now see, it's riskier, so I need a little bit more interest, a little bit higher return to offset that risk. Okay. Now, in the next phase of this discussion, we're going to start to learn how to calculate a bond's value. But to do that, we have to get some key jargon out of the way. So here is some basic bond terminology. Number one, the issuer. This is the person who's borrowing the money. This can be the government or the corporation or the state or whoever is borrowing the money. Number two is the investor. This is the person who's lending money or who's buying the bond. In other words, you. So these are the two players involved. Now, we know that bonds pay interest. So the next three terms relate to the interest payments. The principal or face value or par value of a bond, those three terms are used interchangeably. The principal, the face value, the par value, this is the bond's stated amount. This is the amount that the bond is valued at. You could also call this the nominal amount. Okay. The coupon rate is the bond's interest rate. Whenever you hear the term coupon in the bond discussion, coupon refers to interest. The coupon rate is the bond's interest rate. So it's the percentage interest rate that the bond is promising to pay you as the bondholder. And then finally, the coupon is the interest payment. So the coupon is the interest payment. And here's the critical thing. The coupon, which is the interest that you earn when you own a bond, is equal to the par value of the bond times the coupon rate. That's critical, okay? So let's say that you buy a bond with $1,000 par value and an 8% coupon. $1,000 par value, also called face value, 8% coupon. $1,000 times 8% is $80. This, my friends, is the bond's coupon payment. This is the interest that you will earn annually from that bond, okay? The idea of maturity and term refer to the bond's due date and the number of years until it matures. Notice that this is sort of tied to the N in our time value. The yield to maturity, this is a very specific term that refers to the bond's annualized return. We'll cover this a bit later. And then finally, the bond's market value. Now, if you're going to make any mistake in this lecture, it's going to be right now, so pay attention to this. The bond's market value is not the par value. The par value is the amount that the bond is stated at, usually in multiples of $100 or $1,000. The market value, on the other hand, is the bond's current market price. In other words, the market value is the current price that that particular bond is being bought and sold for in the bond market. Remember, it's very important that you remember the bond's market value is not its par value. They're different, okay? The bond's current market price, that's its market value, okay? Now, we learned a while back that bonds are the stabilizers in your portfolio. They have less volatility. But that does not mean that bonds have no risk. In fact, bonds can be very risky. There's a lot of different sources of bond risk. Here are four of the biggest. Number one is interest rate risk. In essence, if market interest rates go up, the value of a bond goes down. They move in opposite directions. So interest rate risk refers to the risk that if market interest rates change, the value of your bond may also change. Inflation risk. Inflation risk means this. Suppose, let's say that in our example here, we had an 8% coupon rate. So you're getting $80 a year. Suppose that inflation is going up by 10% per year, though. This means that you're getting an 8% return over time, but prices are rising by 10%. In other words, inflation risk means that inflation effects will devalue both the coupon payments that you receive and the principal repayment. In other words, if there's a lot of inflation, the money that your bond generates for you is not going to have as much buying power, and you're going to get hosed from the inflation. Liquidity risk is the risk that if you have to sell your bond right away, you won't find a buyer. And default risk, which is the main one, this is the risk that the company that you loaned your money to, the company that sold you the bond, that they go through some financial distress, maybe some financial problems, hell, maybe even a full-on bankruptcy, and therefore that they are at risk of default, meaning the risk that they simply won't be able to pay you back. And that's the risk that you take. To help investors understand all of these risks, bonds are rated. And a bond rating refers to the probability that a bond rating refers to the probability that the bond issuer, the company that borrowed your money, can actually pay you back as required. This right here is a very standard chart. You'll notice that there are three primary rating firms: Moody's, Fitch, and S&P Global. You will notice that they all have, starting up on the top and going down, scales from their most highly rated bonds, which are up here, to their most risky bonds, which are way down here. So notice that they all follow a somewhat similar system, but they do tend to have slightly different names in their ratings, okay? But just know that ultimately they're going to start with higher ratings up here and then progressively fall to lower ratings down here. Notice also that right here, there's a cutoff line. Above that cutoff line, the bonds are called investment grade. That's a specific term. Investment grade simply means that the rating agencies have placed the bond above this arbitrary cutoff line right there. Any bonds that are considered riskier than that and fall below that cutoff line are known as speculative grade, or they're known in the everyday parlance of the market by a more common term, junk bonds. So when you hear the term junk bond, that's just a speculative bond. It's a bond that is rated at this point or lower, which means that it's rated to be very risky. You might ask the question, well, if junk bonds are so risky, then why do so many people like junk bonds and invest in them? Well, you should be able to think it through. The riskier the bond is, the more return the bond has to pay. So junk bonds, if they actually pay you out, can offer you some pretty sweet returns, pretty high interest rate. But again, you're balancing those high potential returns with a lot of risk. So that, my friends, is a bond rating chart. Let's get into finally the money part of it. Like any asset, bonds provide return in two ways. Number one, they provide current income. And the current income is in the form of the coupon or interest payments that you receive from the company. These coupons, by the way, are typically paid semi-annually or annually. And remember, we said that the coupon payment is going to be equal to the bond's par value multiplied by its coupon rate. Okay, that's that. Notice, if you think about this, if the bond is promising to pay you a particular PMT over time, we know this already. What do we call an instrument that pays out a certain amount of money steadily over time? In our TVM concepts, we call this an annuity. So when you learn TVM and you learned about annuity calculations, you didn't know it then, but you already have the knowledge that you need to do bond valuations. The second form of return is when the bond holder, when the person who borrowed the money from you pays you, the bond holder, back. So that's the repayment of the bond's principal if you hold it to maturity, or the potential capital gain if you sell it back early. Once again, two forms of return. Appreciation in value, that's right there. Current income, that's right there. Okay. Final big thing we're going to do are some basic math problems here. They're going to seem complicated, but let's break them down piece by piece and you'll get this. So we're going to learn how to determine a bond's market value. Now, remember, we said before in this lecture, for any asset, including a bond, the current market value, meaning the market price, is going to be equal to the discounted present value of all future cash flows. So, given that, we can jump to this statement. A bond's current market value, therefore, will be, number one, the discounted present value of its future coupon payments, plus, number two, the discounted present value of its principal repayment. That's all it is. It's just an annuity plus a lump sum. So you've got the tools to do it. Now, one more thing in terms of jargon. A bond's current market value, meaning the price that it's going to sell for in the market, is not going to be the same as its par value. The par value is the price that the bond is issued at. It's its face value. It's flat, steady. But in the real everyday market, bond prices fluctuate up and down like any other asset. Okay? So we have two specific terms. Let's go back to our pen. Sometimes the bond's current market price is below its premium par value. Sorry, I misspoke. Sometimes the bond's current market price is below its face value or par value. So in this case, the bond's, we'll call this the bond's market price is less than its par value. This is known as trading at a discount. So when a bond is trading at a discount, it means that its current market price is below its par value. On the other hand, sometimes a bond's current market price, the price that it's buying and selling for in the bond markets, is actually higher than its par value. In other words, the bond's market price is greater than its par value. When this occurs, we say that the bond is trading or selling at a premium. So you should know now what discount and premium mean in the context of a bond's market price. It's the relationship of the current market price to the par value. All right, now let's get some nitty-gritty. Let's determine the price, the market value of a bond. Now, to do this, you're going to need some inputs. The inputs that you need, number 1 and number 2, the bond's par value and the bond's coupon rate. The par value and the coupon rate. As we demonstrated earlier, multiplying those gives us the bond's PMT. You need the bond's maturity timeline. How many years till it matures? That's the N. And you need the investor's discount rate. Now, this is going to be the I that we discount it back by. It's important, it's critical that you understand that the bond's discount rate is not the same as the bond's coupon rate. They're totally different. Do not confuse them. In fact, to make your life easier, remember this. You only need the bond's coupon rate one time when you're calculating the PMT. Once you've got the PMT calculated, you don't need the coupon rate ever again. What you do need, though, is the discount rate that you as the investor have by which you will discount those future cash flows back to the present. This discount rate, that's your required rate of return, which, as we said before, is tied to the bond's risk. Seen another way, the discount rate that you have on a particular bond would reflect the interest rates that you could earn on alternative comparable bonds. So let's say that, for example, right now, let's say that you bought a bond with an 8% coupon rate. Great. And that today in the market out there, interest rates on other bonds, on similar bonds, are 10%. In other words, you bought a bond at 8%, but since the time that you bought it, the market conditions have shifted, and now that bond would generate 10%. This becomes your discount rate. We don't really care about the coupon rate anymore. What we care about is, as an investor, what interest rate, what return could you pull today on an alternative comparable investment? Okay. So we're going to always look to the macro economy and current interest rates to find our discount rate. All right, let's get into it. Let's take an example. There is a bond. It has a $1,000 par value, an 8% coupon, and 7 years until maturity. And right now, the current market interest rate is 10%. What is the value of this bond? What is the max that you would pay for this bond? Now, this sounds very hard. So let's get ourselves organized. Let's first do some cheat sheet. We know that our par value is 1,000. We know that our coupon is 8%. Putting those together, we know that our PMT is $80. So PMT is 80. We know that our N is 7. Don't make a mistake here. It's not going to be the 8% coupon. We already used that. That number is now done. The I is the discount rate, the comparable rate on other investments, 10%. And of course, we're trying to solve for the present value. We know that the future value when the bond matures is going to be $1,000. So we've already got our cheat sheet stuff here. We can plug these in. We can also visualize this as a timeline. Here's what I would do. This bond looks like this. 0 today, 1, 2, 3, 4, 5, 6, and 7. We know that this bond is going to pay you $80 a year in coupon for the next 7 years. We also know that this bond is going to pay you $1,000 as a lump sum repayment in 7 years. So the value of the bond is simply this. The value of the bond is the present value of the annuity stream discounted at N equals 7, I equals 10%, added to the present value of the discounted repayment. Again, discounted back by N equals 7, I equals 10. If you have your time value charts handy, you can see that we would have the present value interest factor for $1. N is 7, I is 10. I'll use a different color here. N is 7, I is 10. Did I get that right? Present value, did I get that right? N is 7, I is 10. Present value, yep, there it is. I think I made a mistake here. No, it's there. Wait, give me 1 second. Make sure I got this right. Yeah, so it's going to be right there. And then for the annuity, N is 7, I is 10. We're going to go to our annuity table. N is 7, I is 10. Oh, you know what? No, I made a mistake. Sorry about that. I got my terms mixed up. It's N is, yeah, that's up here. Sorry, it's 7 years, 10%. Sorry, so it's 7 years, 10%. Sorry, I made a mistake. Forgive me. That's 0.5132. And then down here again, it's going to be 10%, 7 years. There it is, 48684. So those are our factors. I got my N and my I mixed up. So if you think about it, if you put them all together, it's going to be equal to, well, let's get this here. We said that the PVIFA for 7 and 10% was 4.8684, and the PVIF for 7, 10% was going to be equal to 0.5132. And now we know how to do it. We plug them in. The bond's price is going to be its present value. It's going to be equal to 80, our PMT, multiplied by 4.8684, plus our repayment, 1,000, multiplied by 0.5132. That's going to be equal to 389.47 plus 513.2 902.67. In other words, the present value of the discounted future cash flows equals 902.67. That would be the maximum that you would pay for this bond. And that is what we would expect this bond to sell for in the bond market. Okay. Sorry, I made a mistake on that N and that I. I got confused. It happens. You just take your time, get to your right factor tables, find your intersection, circle it, and solve it. But the big thing is that you see how bonds work in the timeline and in the time value sense. And there you go. Final thing I want to share with you when it comes to bonds, and then we'll quickly jump into mutual funds. Bonds, when we talk about bonds, we also talk about bond yields. And bond yields are another way to measure their return. Remember, we're always trying to compare alternative investments. We need to compare apples to apples. So bond yields are ways to help us measure a bond's return. Unfortunately, there's not just one yield. There's multiple yield calculations. I'm going to share with you 3. Current yield, yield to maturity, and the ETY, the equivalent taxable yield. Let's start with current yield. Current yield is very simple. The current yield is equal to the bond's interest payment divided by the bond's market price. In other words, how much money do you have to pay in order to generate a particular coupon payment? So let's say that hypothetically in our previous example, we determined that in our previous one, we had a PMT of 80, and we said that the market price was 902. So the current yield will be 80 divided by 902, or 8.87%. That's the current yield. That means that for every dollar that you spend today on that bond, you'll get 8.87% returned to you as coupon. Okay, so that's the current yield. Easy, straightforward stuff. Once again, annual coupon payment divided by the price. Now, the second one is the yield to maturity. These are a bit more complicated. Generally, if you're going to do these, you do them with the financial calculator. But I am going to give you here an approximation formula. So the yield to maturity is equal to I plus FV minus CV over N divided by FV plus CV over 2. This should look a little bit like the formula earlier from stocks. Why would that be? Well, think about it. Once again, a basic principle of investing. We believe that all investments generate return in one of 2 ways. The current income, which is the interest payment, and the appreciation in value, which is the difference from FV and CV. You divide that by the number of years, and there you go. Notice that we divide it by this to even it out, and then we're done. So this formula, it's a good enough approximation. Question you might ask is, when would you use current yield and when would you use yield to maturity? Well, the current yield is only about the interest coupon payment. But remember a minute ago, we said that you can buy a bond at premium or a bond at discount. I want you to imagine that you buy a bond with $1,000 par value, but you buy it at a premium. You pay $1,200 for it. Well, you've paid $1,200. At the end, you're only going to get back $1,000. So you'll be losing a little bit of money there. Now you're asking, why would I possibly do that? Well, you would do that if the interest that you're going to receive in the meantime offsets that. But for now, it's enough for you to remember that if you buy a bond at a premium, you're paying more for the bond than you're going to get at maturity. The yield to maturity factors that drop in. On the other hand, suppose that you buy a $1,000 par bond for $700. Interesting, because on top of the annual interest that you make, you're also, if you hold the bond to maturity, you're also going to get $1,000 back when you only paid $7. So you're going to have a relatively bigger yield to maturity because on top of the interest that you're getting, you're going to get the appreciation in the value of the bond, the difference between its par value and what you paid for it. Okay. So that's what yield to maturity tells us. The third and final one I want to share with you is ETY, equivalent taxable yield. First, the formula. ETY is equal to the tax-exempt yield divided by 1 minus your marginal tax rate, which we learned about in an earlier lecture on taxes. So what is this all about? Well, here's the important thing to remember with this one. Almost always, any interest that you earn on a bond is considered income and has to be reported on your taxes as income. No problem. However, there are exceptions. For some bonds, in particular municipal bonds, bonds that are issued by state or local counties to finance their operations, here's the key. The interest from municipal bonds is tax exempt. You don't have to pay taxes on that income. It's not reported as a taxable line on your tax return. So while the interest from most bonds is not tax exempt, the interest from muni bonds is. So suppose that someone said to you, hey, Tesla's paying 8% on a bond. The state of California is only paying 6% on their muni bond. If you didn't know the tax implications, you would say, well, don't buy the California bond. Tesla's paying 8%. California's paying 6%. Take the higher yield. But then you have to remember those Tesla interest payments are going to be taxed, lowering your real return. We have to find, my friends, we have to find basically here, we have to find a way to make an apples to apples comparison to compare the returns from taxable bonds and tax exempt bonds. And that's what this does. So let me give you an example. Let's do an example. Let's suppose that there's a muni bond, tax exempt, that pays 5.55%. Suppose that an Apple bond is paying 7%, and suppose that your marginal tax rate, we'll make this, your marginal tax rate is 22%. So given that, should you buy the muni bond or the Apple bond? The amateur would say the Apple bond, it pays more, but you know we have to account for the taxation. So we calculate the ETY for the muni, and it's going to be 5.5% divided by 1 minus 0.22, which is 5.5% divided by 0.78, which is 7.05. What does that mean? Well, here's what it means. That municipal bond that pays you 5.5%, given your tax rate of 22%, that's the equivalent of a regular corporate bond paying 7.05. In other words, if you receive 7.05% and pay 22% taxes on it, you're actually walking with 5.5. Notice there, now the Apple bond pays you 7%. The muni bond has an ETY of 7.05. this is actually the better bet because of the tax impact, okay? So once again, you can think that ETY is the return that a taxable bond would need to generate in order to equal the return on a comparable tax exempt. Again, if the muni is paying 5.5 and your tax rate is 22%, the ETY is 7.05. A taxable bond would have to pay you that percentage in order to make it worthwhile. Since Apple's not doing it, we're going to not buy Apple, we're going to buy the muni. Okay. Final thing here, we had said before, interest rates, yields, and prices, there's some relationships. So just know, in terms of your bond knowledge, that there is an inverse relationship between interest rates and a bond's price. When interest rates go up, bond prices fall. When interest rates fall, bond prices go up. If you don't believe me, take a few different interest rates and plug them into this timeline, and you'll prove it mathematically. And then finally, the other relationship, there's a direct relationship between rates and yield. When market rates go up, yields go up. When market rates go down, yields go down. If you put 1 and 2 together, you can also see that when bond prices fall, yields go up. When bond prices rise, yields go down. Again, it can be confusing, but I just want you to get you aware. I want you to be aware of that jargon. So we know that bonds play an important role in your portfolio because they reduce risk by reducing volatility. And especially when you're older, they can generate steady, predictable interest payments. On the other hand, for that lack of volatility, you're going to get rates of return that are typically below stocks. How do you do this the best way? Well, once again, my friends, you don't have to reinvent the wheel. Go back to the right tool for the job. A simple strategy: bond mutual funds. Just like there's mutual funds that hold stocks, there's mutual funds that hold bonds. They take all the money from all the many investors, they pool that money together into a mutually owned fund or mutually owned pool of money, and then they'll buy lots and lots of different bonds with different risk exposures and different maturities to really lower your volatility. So no need to buy or think through individual bonds. Just buy bond index funds and you're good. Whenever you're doing index funds, you want to compare with the index rate. So know that for bond index funds, some of the major bond indexes are those. Okay, that's bonds. And let's wrap up this discussion with a quick hit on mutual funds. By now, we've talked about them a lot in a previous lecture and indirectly in this. Let's now systematize our knowledge and just get it going. This will be a quick one. A mutual fund ultimately is a type of investment that receives money from many, many investors. Some big investors, some small investors. Doesn't matter what size. Each investor contributes what he can. That money is then pooled, and the mutual fund then takes that pooled money and invests it critically in a diversified portfolio of assets. An ETF is ultimately just a variation of a mutual fund. An ETF, it's another type of pooled investment. The main difference between mutual funds and ETFs is that ETFs trade in real time like another security. So the price of an ETF can rise and fall moment by moment on a market. On the other hand, mutual funds only trade once per day when the market closes. Okay, this is a real technical difference. You don't need to really worry about it. What you do need to remember is that for most investors, mutual funds are the way to go because they provide simplicity, low expenses, a nice way to automate and grow your wealth over time. They're truly the best friend for the beginning investor. Okay. Ultimately, mutual funds are based on the idea of pooled diversification. This is a basic idea in insurance as well. And it comes down to this. If you can pool your money and buy a large collection of different assets and hold multiple assets and not just one, you're going to be a lot less volatile because you've got your eggs spread in different baskets. What's important to point out is that mutual funds, it's just a type of investment where the money is pooled and assets are purchased. The question, what kinds of assets can be purchased in a mutual fund, it's wide open. Mutual funds can pool the money together and they can therefore buy all kinds of assets, stocks and bonds, cash instruments, and commodities, for example. All mutual funds behave in the same way. Where they're different is in the type of asset that they purchase. All you have to do is look at the name of the fund, though, and you'll be able to tell what it's buying. If that doesn't work, you can also read a document called a prospectus. And a prospectus tells you both the mutual fund's goals and philosophy and the types of assets that they do and don't invest in. Okay, so a mutual fund pools money and buys a diverse set of assets, maybe stocks, maybe bonds, maybe commodities, maybe cash instruments, maybe a combination of them. They can also be blended. The combined holdings are called the portfolio. And here's where it all comes together. As a mutual fund investor, you own a share of the fund, and therefore you own a proportionate share of the portfolio that the fund has invested in. So imagine a fund takes a bunch of money and buys a whole diverse slew of assets. It holds them in its mutual pool. As a mutual fund investor, you own a little sliver of that big pool. It's a beautiful thing when you think about it, because you get all the diversification and potential growth of all those assets. But because you got so many, you also bought diversification. Without mutual funds, it would be very hard for small investors to diversify. I don't have enough money to buy lots and lots of different kinds of stocks individually, but I don't have to. I just buy a mutual fund, and the diversification is built in. Okay. Now, structurally, the mutual fund itself is owned by you and me, the investors. Since we put the money in, we own the fund. The management company, biggies include Vanguard and Fidelity, they manage the fund's daily operations. And the management company, to do that, hires the fund manager and all the other support staff who make the portfolio decisions. Like we said in a previous lecture, we have active and passive management. Mutual funds can go in either direction. So some mutual funds are actively managed. Those are called managed funds. And others are passively managed. Those are called, as we know, index funds. You're probably, when you're starting off, going to want to stick with the index funds because you get the same diversification, but they're going to have lower expenses. And as we learned in a previous lecture, when you lower your expense ratios, you keep more of your money, they get less of it, and future you does better. And as we mentioned earlier, a prospectus is the document that lays out the fund's philosophy, objectives, policies, etc. Okay, that's that. Now, I'm just going to reiterate something in a different way to really make the point. What are the major types of mutual funds? Well, by definition, the major types of mutual funds would mirror the major types of asset classes. So number one, there are what are called money market funds. These are mutual funds that invest primarily in short-term, liquid financial assets. The goal of these would generally be to preserve your capital, not lose any money, while earning at least a slightly higher return than our friends at Bank of America and Chase are going to give us. And their returns are crap. A stock mutual fund, also called an equity mutual fund, because stocks are called equities, that's going to invest primarily in common stocks. In the earlier part of our lecture on stocks, we talked about all the ways that we can slice and dice stocks. Well, in the same way that we can slice and dice stocks, we can slice and dice stock mutual funds. In fact, every type of stock mutual fund will have a particular emphasis or objective based on the stocks that it's buying. So some stock mutual funds might have an emphasis on company size. That's a large cap mutual fund or a small cap mutual fund. On the growth or a value focus, that's a large cap growth fund. That's a medium cap value fund. Or maybe both. That's a large cap blended fund. You might also see it based on geographical location. VFIAX invests in the S&P 500 stocks, which are the 500 largest American firms. So that's domestic. But you can also find mutual funds that invest in foreign, international stocks. So however you can slice and dice and divide stocks, you can do the same with mutual funds. And then finally, bond mutual funds, as you would suspect, invest in a broad portfolio of bonds. Mutual funds is the broad term. There's specific specializations within that. The one that I really want to draw your attention to, index funds. As we've said before, index funds, which are a form of mutual funds, they simply attempt to replicate the composition of and match the performance of an existing market. When you buy an index fund, you're not trying to beat the market. You're just happy to match it. The beauty of index funds, though, is number one, they're simple. Number two, they provide diversification. And number three, because they're passively managed, they're low fee. Now, there's also funds called balanced funds. A balanced fund will buy both stocks and bonds in a different asset allocation. These are also called hybrid funds. Sector funds are funds that invest primarily within a particular sector: manufacturing sector, tech sector, energy sector, banking sector, health sector, etc. And life cycle funds, also called target date funds, these are the funds that automatically do the asset allocation for you, switching you from out of, I should say, riskier stocks and into safer bonds as you get older and closer to your retirement. So those are life cycle funds. A key term when it comes to mutual funds is net asset value. The net asset value for a mutual fund is equal to the value of all the fund's assets minus the value of all the fund's liabilities divided by the number of shares outstanding. In other words, the number of shares that the fund has issued. So the net asset value is equal to all the fund's assets minus all its liabilities divided by the number of shares outstanding. That is the value of each individual share of the mutual fund. Here's the critical part. the NAV, the fund's net asset value, this is basically the mutual fund's price. And this is the price at which all of the buy orders and sell orders for a particular day are carried out at. So the way it works is this. Let's say that you want to buy a mutual fund tomorrow, or you want to sell a fund tomorrow. You go to your brokerage online, you put in your order, buy 100 shares of this mutual fund, sell 30 shares of that mutual fund. You put the order in. At the end of the trading day, the systems will automatically calculate the NAV by taking the value of the fund's assets, subtracting the value of the fund's liabilities, dividing it by the number of shares outstanding. That NAV, that is the price at which all of that day's buy orders and sell orders are carried out at. Okay? One other subtlety, in case you're wondering, what is the value of all the fund's assets? Well, that's simple. The value of a fund's assets is simply the value of all of the fund's underlying securities. So at the end of the day, the fund will look at all of the securities that it owns, take the market price for each, multiply it through, add it together. The value of all the fund's underlying securities, that's the value of the fund's assets. That is subtracted from the liabilities, divided by the shares outstanding, and that is the NAV. Really important idea, because that's the price that the securities, that the mutual funds were bought and sold at. Okay. How do funds provide value? Mutual funds provide value in three ways. It's the same as in the other things with one little tweak. Number one, mutual funds provide return by way of income distributions. Think of it this way. Suppose that a mutual fund owns stocks and bonds. Those stocks and bonds then pay out dividends and interest to the mutual fund. As an owner of the mutual fund, you get your share of those dividends and interest. So again, the earnings from any dividends or interest that are generated by the assets that the fund holds get paid to the fund, and then you get your proportionate share based on your ownership. That's number one, income distributions. Number two, capital gains distributions. Now, remember, the fund owns assets. If the fund itself buys and sells assets and generates a capital gain. So let's say that you're a mutual fund, buys 100 shares of Apple stock for $5 and then later sells those shares for $12. The fund itself earned a capital gain on the stocks that it owned. You as an owner get your proportional distribution of those gains. That's the capital gain distribution. This is the earnings from any capital gains when the fund buys and sells securities. Notice, my friends, that 1 and 2 are within the fund assets. In other words, income distributions and capital gain distributions, those are generated by assets that the fund itself owns. The third source of gain is capital gains. And this is when you yourself, when you, the investor, sell shares of your mutual fund at a higher NAV than you bought it at. So this is on you. So once again, numbers 1 and 2, These are gains that you get proportional distributions of based on assets that the fund owns. Number three, this one is based on capital gains when you buy your own shares of that, buy or sell shares of that mutual fund. Those are the three ways that they generate value. Okay. When we put all this together, a mutual fund's return is going to be equal to its distributions, which is the current income, plus the NAV at the end of the period minus the NAV at the beginning of the period, all divided by the NAV at the beginning of the period. Once again, we're looking how much distribution in current income, how much growth. Together, that's your total return. You divide that by what you had to pay to get it, and this will give you your return, as always, measured as a percentage. Now, just like you can do approximate yield on bonds, you can, and stocks, you can do them on mutual funds too. And here's the formula for that. You'll see once again, so it's the dividends and capital gain distributions. That's the current income. This is the potential growth in it. Divide that by the N plus the beginning divided by 2. Same formula as before, just a slight variation. This is how you would determine a mutual fund's approximate yield. And once again, you could use the yield to compare this mutual fund to potential other opportunities for investing. Final part of this, we have to really cover expenses and fees. We learned in a previous lecture that you have to minimize your expenses and minimize your fees, because every dollar that you pay, you don't keep. Someone else keeps, and future you won't have. So let's quickly talk about fees. And the two primary categories, when it comes to mutual funds, the two primary categories are what we call loads and what we call administrative expenses. Loads are basically commissions. A load is simply a fancy term for a sales commission on a mutual fund. Some mutual funds charge you front-end loads, which where you got to pay a commission to buy in. Some mutual funds charge you back-end loads, where you got to pay a commission when you sell to get out. If you pay loads, you're a jabroni. You have to minimize your fees. And therefore, what you want to strive for always is to only invest in no load funds. Never buy mutual funds that make you pay a commission to get in or get out. Focus on no load funds. The second category are the administrative expenses. These are the expenses like 12B1 fees, which are for marketing, and for management fees, which are the fees to pay the fund manager and all the people who run it, and all the other fees, the accounting fees, the legal fees, all the other fees. All of these fees are summarized in a critical number called the expense ratio. Your goal, number one, when you invest in mutual funds, pay no load. Your second goal is to pay the lowest expense ratio possible. If you pay loads and pay high expense ratios, you are giving away money. You must keep as much as possible. You must focus on what you can control. And that means that you minimize your fees, so you pay no loads, and you look and research in the prospectus, you look for mutual funds with the lowest possible expense ratio. Okay? We already got this. Loads, 12B1s and fees, we got those. The expense ratio, we also got this. This is really the important one here. The expense ratio is the fund's total operating expenses divided by its assets. It's going to be measured as a percentage. You want that as low as possible. Okay. Again, smart investors always minimize expenses. So you're going to pay no loads and low expense ratios. Finally, we can look ahead a little bit. Mutual funds should be your primary investment vehicle, both for your ongoing needs, but also for retirement. Investing in mutual funds through a retirement account is an excellent strategy. In the earlier lecture on investing, I hinted at this, but I want to reiterate it again. Remember, we have retirement accounts. These include 401k plans or 403b plans or IRA plans that you set up. The retirement account is the vehicle. It's the bucket that holds your assets. So the retirement account is the vehicle with particular tax benefits that you invest through. So you can think of your accounts as the bucket. That bucket might hold your assets for retirement or for your child's college or for your future health needs or whatever. But ultimately, the account is the vehicle that holds your assets. The critical thing about the account is the accounts typically have particular tax benefits. So you want to find the right account to give you the right tax benefits to minimize, defer, or eliminate taxes to grow your wealth in the best way possible. So again, the retirement account is the vehicle that you invest through. The mutual fund is what you actually buy to invest in. In other words, you want to buy mutual funds and hold them in retirement accounts. And when you think about retiring, that goes hand in hand with a couple of other great ideas, which we discussed before, including automatic investment. This is DCA. DCA is a provision by which you will invest amounts of money automatically over time. This allows you to buy more of the asset when the market is down, okay? It's called dollar cost averaging, DCA. It's basically what you set up to contribute a set amount of money periodically from your paycheck or your bank account into your retirement fund, into your mutual fund, okay? This is a great strategy. In addition to automatic investment in DCA, you should look at automatic reinvestment. And this is what we call DRIP. With DRIP, if your mutual fund pays you any capital gain or dividend distributions, you don't take those as cash, but rather you take those distributions and you automatically plow them back into your account to buy even more of the asset in question. Mutual funds plus no loads and low fees plus DCA plus DRIP is an excellent pathway to future financial security. Okay? And that's what I leave you with. You should use mutual funds. How do you use them? Start early and think long term. The best time to start investing, how about this? The best time to start thinking about retirement is yesterday. The second best time is today. Start now and think long term. Always minimize your expenses by focusing on expense ratios and refuse to pay loads. Keep your investing life boring. Passively managed, low fee, low expense index funds. Hold those funds in the proper accounts, especially for your retirement accounts like a Roth IRA or a 401k for retirement, or like a 529 or HSA for college savings or for health savings. In other words, figure out your specialized goals and then find the right account for it. Find the right tool for the job. Avoid shooting yourself in the foot and making dumb primate monkey mistakes by automating always. Draw up your money map, make your connections, and automate your money system to invest constantly, and then also set up drip. You do all those, and you're on your way to a financial future that you'll be very pleased with. And that is my final wish for you right now. I hope that for you, you deserve to be happy. You deserve to set and achieve great goals. Here we have the technologies and the tools and the strategies to achieve those goals. Take advantage of it. Be bold, be confident, be wealthy. Thanks for your time and have a good day.